Greetings, market rebels. Welcome to this week's macro measure. I'm Wayne. My partner Ryan's working on the market outlook overview, which will go out a little bit later today. Let's get started on our disclaimer. Sunday, May 14th, 2023, about 20 in front of 11 here. And we just got to get this to cooperate a little bit. Here's our trusty disclaimer. If you'd please take a look at that. And then here is our trusty intellectual property rights notice, if you would do the same. And then finally, this week's really brief program. So first off, happy Mother's Day to all those mothers out there. Definitely want to make sure I get that conveyed to everyone. Mothers do so much for their children. So let's recognize that and thank them. That's what we plan to do today. Anyway, that's one of the factors that's forcing just a really brief, kind of mercifully brief technical review only this week. So I'll be skipping a lot of the stuff I'd like to interweave into things. In terms of the summary, the review and summary are up there, just a lot more brief. Different issues, logistics, coordination. That's what's really driving the short version of everything. So I'm looking to get things taken care of right away, get them out there, and then hopefully that'll give folks time to sneak in a quick view. But I'll leave this up there. I'll go through each one sort of off screen. We'll cover things, but the bottom line, unfortunately, is that, and well, let's skip right to here. I think hopefully my cursor's showing. But this last week was a quick review. We ended up with a quick review on that. I mean, we kind of came to the conclusion that, hey, like a little bit more bull control maybe, but not really a strong lean again. And there you go. I mean, 6 week in a row, one of the longest stretches we've had in a while. We talked about Microsoft and Apple being a little bit on the short-term overbought, and maybe some other areas could help, like semis and some other bigger names like Amazon and Google. Maybe they could do something to keep the rally going. Interestingly, they did try, but semis really had their chance and failed to seize the opportunity. But despite that, we did see a new recovery high in the QQQs here in macro measure. So I'll talk about some, I think, important things in the sector situation as well. But just to note that the current assessment, I think, is slight turn for the worse overall. Things had their chance and they really didn't go. I don't think a lot of the key sectors, like I mentioned on Cocktail Hour, are looking very good right now. So that's a little more concerning. I think that the data continues to come in really much to our, I think, expectations. We have not thought things were really roaring out there. Things were becoming increasingly concerning. And that's really what new data has showed mainly, and the stagflation talk as a result is ramping up. But the AI situation has saved the market this year. There's some interesting stuff. Ryan might have his sights on it for including in the market outlook overview, because the narrow leadership we've talked about, but really, if you get rid of the AI factor, the market is apparently down on the year rather than up nicely so far this year overall. So the new talk is that this AI development is going to really save us from ourselves, as always, going forward. I would love for that to be the case. I'd rather see things not go to hell in a handbasket, but I really doubt that we're going to get that saving grace from AI for a variety of reasons. But certainly, I don't know if that in the short run turns everything into this big, wonderful utopian situation. Although I do think it could help the bottom line of a lot of these companies that can adopt it, adapt it, et cetera, and then maybe save on certain costs they've got with respect to employment and so on and so forth. So the bottom line, though, is that we think stock market continues to ignore economic data, and that's concerning still. I've seen periods like this before, and you wonder how much longer it can do it for. And it seems like it just does it a lot longer than you really would have given it credit for, or the chance to do at the very start of when you recognize it that way. But again, we just have to go with the charts for now. And hopefully we'll break out one way or the other, and we'll at least have something to work with. But I'm not sure what bullish drivers besides the AI spin are going to justify the market's lack of concern at this point. I think it's getting later in the game, really, with respect to the market ignoring how the economic deterioration is there, and how if certain things trigger, it could get far worse much more quickly, probably, than I think the market's looking at right now. So I hope to be dead wrong about that. So let me just stop the share and get the charts going. I do hope to be completely wrong about that. And but unfortunately, not really trying to toot my own horn or anything like that, but unfortunately, anytime I've ever felt this bad about things, I guess would be a simple way to put it. Whenever I felt this way, it's turned out to be the right way to feel just early, which is why the lesson is, for me at least, is don't try to force your macro view on the market, even if it is getting really, what you see in the market action is getting really egregious with respect to your take on things, because it can really take a while. So let's get a couple charts going. Like I said, this is macro measure. We're going to take a brief look at stuff. So let me get the right screen shared again. We're going back to screen 3. And let me try to blow this up a little bit. A little magnification won't hurt. And this is what we've been referring to, right? This has been tough. We have not had a strong lean in 6 weeks overall so far, and counting, maybe. And it's really been, I think overall, that's been the right way to feel, pretty consistently week in, week out. And we're still really waiting for something here in the SPY. I even just I think the rectangle is probably a lot more important, since the triangle I drew is within the rectangle, really. But yeah, I think that range, that we have to break this range. And but I mean, just trying to get anything to happen, I put these lines on there, hoping that would start to deliver something, right? But no, it did not, as if that has an effect on anything, right? But bottom line was, like, we're stuck here. Everyone knows it, everyone feels it, and it's not like we've seen something really, I think, this narrow for this long in a while. I think it's been quite a while. I did see something on that, but the actual, like, last time this happened, dates escape me right now. I can't recall what they were, and I have to keep this really moving along briskly, so compared to usual, at least. So anyway, there you go. You're stuck there, right? If we look at all 4 of the major index ETFs that we typically do, because folks prefer that we chart these instead of the just indexes themselves, because they like to potentially trade these, which makes sense. These are a lot easier in terms of dollar cost and et cetera, better bid-ask spreads to trade in. But the Qs, right, they made a new high. It didn't really close impressively, but the Qs at least made a new high. So we had that little slight bullish lean. I'm not trying to take credit for anything, trust me, but so that kind of bore out in the Qs a little bit, not so much in spiders, and certainly not in IWM. IWM just it tried a little bit midweek and then got sent packing all over again. We've been talking about the 50 SMA. I'm sorry, we've been talking about the 50 SMA and that resistance line that I'm about to click on right there. Oops, I didn't grab that, for some time, and saying that's really what this really has to do to get something more important going. And it just hasn't been able to do that. And this is starting to look more concerning, I think, right? That you're dropping down here. Let's take a look at the diamonds, just to kind of start out everywhere we typically look at. And those didn't look very good either, right? I mean, that's not really a great week right there. When you end back down here, and you were saved by the 50 in gold and the 150 in orange, respectively there. But that's not a pattern that you love. You might like this strong sort of impulsive move and this corrective action, and that you're hanging in there and you couldn't still go, which I would grant. But right, with all these short-term SMAs rolling over the way they are, and you're within, like, really one rough trading day of threatening the recent low, and only leaving the 200 SMA there in purple to the south. Everything else would be to the north. So not a good look. Not a good look when you look at this, and you look at this part of the sort of channel, this corrective channel that I just highlighted in both with both lines there. And if you can't hold on to this, that's a problem, right? The idea would be you leave there, you prove you can hold above it, then you go for another run, try to attack the highs, and possibly go further. Could still happen, not ruling it out completely, but I think at this moment in time, that's all we can do is chart this moment in time. And I don't think they look particularly good right now. In fact, I think someone had said about, if you go back to May, and I'm not going to do this on all four of these, but if you go back to May of last year, we're just about where we were May of last year in these major indices. And it's true, right? There you go. Like you're 2 weeks removed from that. So there's your June 1st of last year, and you're really very close to where you are. So we've had a lot of movement at times, not lately, but at times, and we haven't really gone anywhere. We haven't really accomplished anything in terms of price advancement. And I guess the real rate of inflation, right, which is even worse than the stated rate of inflation, you're doing even worse than that, clearly. But that's just an aside. But I don't think right now that there's this clear situation where you could say, well, everything's oversold, so we can really start thinking, hey, with any little break, we should get ready to go because we're ready to really power. That could happen, of course, but I just don't see any catalyst for that. I mean, the best catalyst that I've got that's just really a straightforward thing is about 10 days away in the form of NVIDIA with earnings. And maybe they say something that's, really a turning point in terms of everything's getting much more wonderful. I mean, certainly the stock performance has been wonderful, certainly holding virtually above all the SMAs, most of which are upsloping, even the shorties. That's all good. It just that, if that doesn't drive it, I don't know what will. It could be more of this AI stuff. I think a lot of us know that the leadership has been extremely narrow, right, in this market, and that's not a good sign. And it's something that ultimately, it's not an immediate cause for action, but ultimately, when I've seen this many times, and when you get this really narrow leadership, it's very hard to really get that bull market type performance. You get a lot of what you got now. You get this big upside move in some of your biggest names, but a lot under the surface, there's a lot of deterioration going on. There's a lot of stocks that are really floundering or making new lows or dropping below SMAs, things like that. So that's not good. Another thing that might not be good, and we'll come back to these, but another thing that may not be good is the dollar is trying to strengthen here a little bit. And I don't know if this will really pull it off. It may, but this is something I think worth noting, even though we'll talk about it again in sector situation, but this is more of a macro thing, right? So getting above the 100 there would open up more space for it. So if that rallies, right, hasn't been good for the market when the dollar is going strong. And just on a side note, you wouldn't expect gold and silver to be doing well if the dollar rallies. And you could see that dollar's been doing better. Gold and silver started backing up in terms of the XAU. I don't want to go into spot prices on the actual metals, but just get the idea in general right there. And so the VIX has been something which I think is always tough, right? It's kind of hard to apply technical analysis to something like that. It's just it's a different type of I guess you would call it an underlying, would be the best way to describe it. So it's kind of tough to really say much about this at times, but that's, again, back towards the lows. And it does sort of make sense in the sense that the volatility has really dried up in the market. So why would people bid up option prices all that much? At the same time, I think the risk continues to grow in the market, and that's a good reason to start buying volatility and positioning for the downside. But I don't know. I mean, maybe someone is out there with a really strong take on the VIX, given what we've seen lately. It's not me. You could argue, well, there's a diamond formation in there because you've got that major kind of really volatile spine that's there in the middle of all this stuff. You could argue that maybe there's something developing like that. I mean, you could. I don't really want to apply the same kind of. That's usually a diamond top, I believe, is really considered the better pattern than the diamond bottom. But remember, this is inverse to the market, so it's sort of similar in that way. But yeah, I mean, I don't think there's any, I mean, I don't really want to chart it that way. I'm just saying that people could make some kind of an argument. There's just not that much to say about it other than you're much closer, right, to multi-year lows than you are anywhere near 20. And you've been downtrending now for some time, ever since they really started crushing this thing. You had this one brief phase, but overall it's been downtrending since they started reversing the market off the October lows. So I mean, I think you could see that it's been a little more volatile lately. But what can you really add, right? This is really contingent. So I think I honestly think we're at a tough spot. I mean, there's just, you got to call it the way you see it, right? So coming on here every week, trying to find interesting things to share with everyone. It's not easy lately. You know, I'm not hanging my head in defeat or anything. I'm just saying, like, it hasn't been easy to find interesting highlights. I still would say this, though: I would not rule out a fake, you know, what would ultimately be a false breakout where they find a way to tack some things on. It could be anything that ignites it. I don't know. Maybe there's some big developments in the Ukraine war. Seems to, other than for snide Twitter commentary, the Ukraine situation seems to have really fallen off the front page in terms of people's concerns and things like that. But let's say that there's some sort of a peace treaty arrived at or something suddenly. Maybe, right, that could ignite a short squeeze. I mean, let's not overlook the fact that bulls will use any excuse to ignite a short squeeze. And so you've got to be on guard for something like that. And that's why you just can't, despite maybe things being unimpressive and things, me and Ryan, you know, a lot of folks believing things should probably be trading lower than they are. And I'm not talking about, you know, 5 points here in the SPY. I'm talking this thing, to me, like, this thing should be back down to the lower side of this recent range that we've been in. I would say somewhere near the 380 level, to say the least. You know, that's where I would think this would be by now, given how things have unfolded. But clearly, right, they've been able to hold it up, and they've done it many times before. But something like that, or I don't know. I mean, I don't know exactly what it would be. It would be maybe some kind of U.S., you know, avoids debt default, that situation, and that ignites it. So you just can't get lured into this is it. I'm really going to double, triple, quadruple down, or what have you, and just start fighting this thing, because it's becoming even more. Let's say if we had a line of reality down here somewhere, and you keep saying, well, this line of reality keeps rolling over, and then this thing continues to hang in there, then the line of reality you'd say, well, it's getting more stretched from the line of reality weight that's rolling over. This thing needs to come down, and it probably will at some point if the line of reality is a good line. But they operate on their own time frame. And I think that's one of the best things I can share if someone's new. Like, don't get sucked in too early, or if you do try it, just, again, be disciplined and hedge, or, you know, get out and look to reestablish at some point. But this is why I try to insist on there at least being some kind of a momentum flip, right? A momentum surge, or a momentum, whatever you want to call it, a momentum shift, where you finally start to see a key level of something get taken out or breaking down. And again, it's hard to argue that we've had that. There's been a couple of false breakout attempts, and there's been a couple of false breakdowns out of the range briefly. But you could see they were sort of waiting for new fresh shorts, and then they just jam it right back up significantly. So that's nothing, again, that's nothing new. If I do go a little bit further, though, because that's what really we're talking about this week, is the charts. If here's a 3-year weekly chart now that we're looking at, and it's really tough to go back to, say, late Nov, so let's just call it December. We could, 2 weeks from now, we'll be tracing out 6 months. And it's really hard to find 6 full months of this kind of range bound action for very long, right? It's not that in the modern market, we've either been, for the most part, we've been trending strongly in one direction or another, or getting better movement. This has been a really tough stretch after that initial, especially after that initial burst that off of the October lows. It's been hard, very hard to trade, I think, comparatively. So there's nothing we can do other than hang in there as best we can. And I know we've been talking about that in Rebel Pit, Cocktail Hour. You just don't see this kind of thing really going back even further in time. You don't see something where it's this sort of, I guess you wouldn't call it a narrowest range, but you kind of have a relatively narrow range in some ways, and you see mainly trending action. So this is something we haven't seen in quite a while. And that's why I think folks are finding the market hard. I think the market's hard. Someone was a little despondent because, obviously I've been doing this for so long and I'm calling the market hard right now, but there's nothing I wouldn't get despondent. I mean, usually this stuff doesn't last. The market, people make money on Wall Street from prices changing and from activity. And so I don't think that, we're our fate is sealed, that we're doomed to stay in this for more and more and more months and even years or something. I think you're going to get something, but it does feel really frustrating and tedious. And it's not even as if like on some good days or good stretches, like this little swoon here or here back up, there's a little bit of money to be made there, but they've been doing so many gaps, or they'll run things very, very quickly. And then you'll go into a narrow range for a lot of the day. And it's tough when the market behaves that way. But this is a great source of opportunity over the course of time. So we just can't throw in the towel. If you want to trade less, sit on your hands more, there's nothing wrong with that. But if you still willing to go for singles, kind of using the baseball parlance, just take your singles and grind something out for now. You can still do, I think, fairly well. But I hate to be this way. I just don't see anything we can seize upon. I mean, I really still think you've got to wait for this range that I clicked on and then unclicked it. So you've got to wait for that range to break. I still think you have potential to do this. I think that to when I say do this, I mean break out to the upside here, just more on a squeeze in my mind. And you have to give them some credit if we look at it a different way, in the fact that they've been able to push this up from October lows and then hold on to most of the gains. Probably, right, we've held on to most of the gains, probably about 1/3 roughly of the gains have been given back from high to low, but that's it, right? So they've held on to most of the gains for now. So we don't want to, despite my concern and my discussion of this invisible line of reality that just keeps, I think, trending lower and lower. It doesn't mean anything yet. You have to this stuff can take a while. I hate to repeat myself, but this thing could take a while, and you just got to trade what you can for now and not really rule out anything. I do feel like I'm getting a little more bearish, a bigger picture, but we're not going to force. And even short term, I think things took a little bit of a turn for the bearish side with the way things finished out. And I'll show some of those sectors in sector situation, which will also be brief. But when I look at my control grids that I like to keep an eye on, the control grids are not saying, they're saying definitely neutral, right? That the control is sort of shared right now, that there's different cycles that are operating where the bears are in control and others where the bulls are in control, but you're really not strong in any direction. And in some ways, the bulls are still hanging in there this way. So I'm really reluctant to, when I see that, like I'm really reluctant when I look across my control grids and I see that stocks are still technically flashing certain ways overall, despite all these growing concerns, let's call it. So I'm reluctant to get too bared up. But one spot I would probably start saying, like, look, this is probably your area, right? And I'll talk about KRE and other things in sector situation, but this is probably the area. I mean, this could change quickly, starting with IWM, that is starting with lifting out of that, right above that resistance line. But this narrow range that it's been in now for several months, this could be cracked pretty easily. And then you could be on your way towards a retest of the lows. And that sort of makes sense, right, with the fact that these smaller companies do not have those balance sheets that can withstand, right, rough stuff for as long as you would think the bigger companies do. So in that case, right, I would, if you're looking for the weaker things right now, I think the IWM is the one to look to first. Qs are the strongest. I would say second weak, and spiders are second strongest. And I would say that the next one would probably be the diamonds here, because they're on the verge of losing that what was resistance has become support. That line right there that I just turned blue, that one to me, you could very quickly be below that and all your SMAs, really, with two reasonably bad sessions in a row. So that's the next one up from the worst. So I would rank them, clearly Qs are strongest, spiders second, probably diamonds third, and then IWM fourth. So I think the IWM and the diamonds are where you want to start looking at, and maybe just look at individual components within there. But the other reminder I want to give out is that I still believe that there's been an enormous amount of money that's been put into this market. So I'll use SPY just to represent the market. I think there's been an enormous amount of money that's front ran things that thinks that, well, we had a bear market, we had a correction. The Fed will still soon be on the way down with rates. The way the market's forecasting it, at least that makes sense. And those are the market expectations. And then, so since lower rates are on the way, then we'll be right back at it in terms of, new great time. So I'm not in that camp, but possible. No doubt about it. It is possible. But if the Fed kind of remains resolute, and when they think this gang that's put this money into the market so aggressively and so to such a great magnitude, if they're disappointed, the Fed kind of hesitates for several months, and let's just assume we're getting into the fall and the Fed is just sitting there. Maybe they're not taking rates higher, but they're not lowering rates. That could really be a problem, right? Because if things continue to get worse and you have the stagflation situation where inflation doesn't come off enough, and yet things are deteriorating, that's where when you look at what I'm calling, again, the line of reality getting worse and worse and worse, and stagflation kicking in, and the market sort of getting stretched, that's when you could have that big, as people call it, like the big dislocation. That's when you could get something where things are just so out of step, and there's so many parties that are then ill-footed or ill-positioned on the long side. So that's what I would keep in the back of your mind, right? If this continues to happen, it just sets up for an even bigger problem down the road. And yeah, I think if we were, my gut instincts tell me, this is not based on some sophisticated formulation that I've got on an Excel spreadsheet somewhere, but my instincts from having been through these things before would be that if we make it through the summer and they keep things buoyed somehow, but things just continue to worsen and worse, and the Fed stays where they're at, and inflation still doesn't come off as much as hoped, then I think you set up for a pretty rough tumble in the fall, when reality starts, I guess, causing even more trouble, right? Where you see more and more layoffs, you see this, and this, and just keeps piling up. And then people will realize that these valuations are not supported maybe as they thought they would be in, say, 24 and 25. They got ahead of themselves, and people start to, again, once you start seeing some selling, the reason why you get these kind of crescendos where there's this big kind of rout is because once people start to see poor price action, it tends to flip more and more people into that camp, and eventually it brings a lot of people into that camp. And that's it's sort of like I think the folks tend to say, like, sentiment will poor sentiment, poor price action will really change, right? That will change the opinions of people. People are really resolute, but when they're discussing this, oh, I'm a long-term bull, I'm hanging in there. But then when things really hit the fan, they tend to reassess and say, I'm getting clobbered, and you get, the firms get redemption calls and people want to cash out. And of course, with the bank runs, we've seen that the market's ignored to a great extent. That also could intensify. So there's a lot of stuff out there. I think the bottom line for the week, not to belabor this too long, is took a little bit of a turn for the worse. Just like the prior week, it took a little bit of a turn for the better. Keep your eyes, I think, on IWM first and foremost. If the market overall is struggling, the Qs are probably the area that, and the spiders are the area you'd look at for if the market starts breaking out, probably. And with respect to the VIX, I would say, look, you're near 17 right now, so that's not a bad level the way that things have been for the past few years, to at least nibble for late year downside volatility in different strategies. And that's something that can really be discussed in the Phoenix portfolio. So something to consider. I still hold a bunch of things. I shifted things around, took some short-term profits and repositioned myself because things fell a little bit more quickly than I expected them to. So I had some strategies that worked out a little sooner than I wish they had. So instead of just sticking with those, I just decided, look, I'd rather just take the money and then reposition myself differently. And hopefully this next time if we do roll over, I'll be able to make the adjustments that I plan to a little more quickly. But that happens sometimes, especially when we're busy. We've been very busy, regardless of the fact that the market's doing this, trying to find whatever we can. It's kind of interesting. When the market's busy, we're really busy. And when the market's sort of frustrating and not doing too much, we're also really busy because we're trying even more, right, to try to dig out whatever we can in UOA to find opportunities. It's not as easy to come by, but you have to just look and look and look more. So it's kind of one of those things where no matter what happens, you're just busy. It really is. The only time really, I guess I'd say that's not the case so much is near the holiday periods or sort of towards the end of the summer. After earnings are done, you get into August, and the last part of August can be a real sleeper at times. So sorry, I don't have anything really awesome to share. That's just the way that it is right now. And as I've said before, I think you're better off just remaining objective and trying to do the best you can. And the art part of this is, I think, keeping your eye on the econ side and these concerning issues. And the artistic part of it is to keep your eye on that, but not let that affect you in the short term in terms of how you handle things. And just be prepared, right, for that. Be prepared that I need to handle this in a certain way if I start to see the deterioration start to affect the stock market. To this point, has been pretty resilient. But again, being objective, not forcing anything, I think it's paid off for us in the sense that we're not, hopefully folks are not going position limits with their calls and puts thinking they're on the verge of something great, because we just haven't been. And so I think it's definitely benefited us to take that approach and not force it. And I'm going to stick with it. I mean, I'm probably slightly more bearish now. I think there's been a little deterioration. So I would look a little more that way. And again, IWM is the spot, I think. And I think you'll see in sector situation that's backed up as well. So not just that IWM and diamonds are looking a little rougher, and the Qs couldn't break out and spiders didn't do much, and we're through most of the EPS. The kind of a weak breakout attempt there. So this is in Qs, but overall, that's what I'd say about the index ETFs. We just looked at the major index ETFs. Nothing really special to write home about. But when you look at the sectors, I think you can see that things have gotten a little bit worse. It's even more clear there. Slightly worse with these views, but with the sectors mixed in and some of those other developments there, that's when I think you really see that, yeah, things are getting worse. And I think everyone knows at this point that leadership's been really poor. So that's what I've got, unfortunately, folks, this week. I want to wish everyone a great Mother's Day. I hope you got at least something worthy of your time out of this video, or hopefully something you could use this week or some week in the future. I want to say thanks for tuning in, and everyone have a great conclusion to their weekend as well. Thank you.